Okay, let's do some cross rate calculations and see how that's done. Let's say that we can observe an exchange rate for CAD US at 139.80, $1 buying $1.39.80 Canadian, and we see the US euro, €1 is buying 109.50 US. So we can see that if we start over here, we can take a euro, get 109.50 US, run over here, take that, and get so many Canadian. But instead of 1 buying this, we have 109.50 buying this. So I think it's easy to see how we can get a cross pair if we want the CAD over euro, right? This is CAD over US, US over euro. If we multiply them together, we can see that the US dollars will cancel out and we'll end up with CAD over euro. So to get CAD over euro, because these are fractions, all we got to ratios, all we got to do is multiply the two rates together. 1.398 times 1.095 is 1.5209. What this is saying is 1 euro buys 1.5209 Canadian. Because 1 euro can get 109.50 US, we can take our US over here and multiply by this rate to turn it into Canadian. So that gets us a cross pair. This is called a cross pair. We can take two majors and get a cross pair. Have a look at this one down here. CAD over US is 139.80. Yen over US is 121.10. Find the yen over Canadian. Well, we can't put these together. Why? Because the US is the denominator on both. They don't cancel out. So what we're going to do is we need the yen in the numerator. Here it is in the numerator. We're going to leave this pair the way it is. We want the Canadian in the denominator here, so let's first invert this. So CAD over US is 1.398. US over CAD is 1 over 1.398, which is 0.7153. Now we can multiply the two. The US dollar will cancel out. It's 121.10 multiplied by 71.53 or 86.82. So what this is saying is that 1 Canadian dollar will get 86.62 yen. Example number 3. Let's take the cross pair of the Swiss euro. Decompose that. Decompose that cross pair into majors. Well, that's easy enough. All we have to do is break the Swiss out. It's in the numerator. Keep it in the numerator. Take the euro, stick it in the denominator of another pair, and just make sure you have an offsetting currency that cancels out, and put the US dollar here and put the US dollar above that. There you go. So you can create cross pairs from the majors, or you can take a cross pair and decompose it into the majors. Right, let's look at forward rates and forward calculations here. And first we need to get some terminology out of the way. Not a lot here. This is rather easy stuff here. Forward rates are typically quoted as a spot rate plus points. So whatever the spot rate is, and then there'll be some points. These points are just adjustments to the spot rate depending on how far into the future we're looking. Spot plus points, so if we're taking the spot rate and we're adding some points, and these points are usually expressed in pips. We could say spot plus pips, but we call them points, right? So if we're taking the spot rate and adding points, that's called a forward premium. If we're taking spot rates and subtracting points, we will end up with a forward discount. And this is in terms of the base. So let's have a look at an example. Let's take the US Euro spot at 128.75. And let's say we're looking for a 1-year forward rate, and we're quoted 128.485. Well, if the current spot is 128.75, and we agree on an exchange rate a year from now, and that forward rate is 128.485, that is lower. So this is called a forward discount. And in terms of points, if we were given a spot rate and we were asking for the 1-year forward rate, we might not be given the rate, we might just be given points. Negative 26.5 we might be given. So how that works is the 26.5, these are pips, they line up with the last two decimal places. So 26 lines up with the 7.5 and then your 0.5. You take 2875 minus 0026.5, you get to 2848.5. So if you just quoted the points, you can just do the calculation and figure out what the 1-year forward rate is if we know the points. And forward rates are typically quoted as the spot plus points. And then you just figure this out. So let's have an example of typical rates a dealer might quote. And these are standard forward rates. And if you're in the forward market, you don't have to take these. You can say, well, I don't want 3 months. I want 114 days. Okay, well, we'll figure that out. Don't worry. That's what we're here for. But these are standard quotes that they'd give. So if the spot is 12875, they might quote 1 week points as negative 0.3, 1 month as negative 1.1, all the way down. You can read these. So let's see if we can come up with a 6-month forward rate from the spot plus points. It would be 1.2875, and what are our forward points for 6 months? Negative 13.3. So the decimal place lines up with the end of the spot rate, and you just line them up under here. That 13 comes off to 75.3, and then you get 1.28617. That is the forward rate that would be in a 6-month forward contract given this spot rate and this point structure. These points, by the way, are also called swap points. Typically, now you'll get this in level 2, but typically here what we have is we have a spot rate with points. Typically what you'd have is you normally wouldn't have a spot rate. You'd have something like this, 1287375. And your 1 week spots would be quoted with a bid and an ask on both of them. So if you were entering into a forward to buy, you would take the spot plus these. If you were entering into a forward to sell, you would take the bid plus these. You would use the points on the bid or the offer. This is just a one set of points, which you might think, well, that's the way it is. Just keep in mind that the points also have bid and asks. This is just to make just to let you in on, well, what does this mean, this spot plus points? And again, these are also called swap points. If they're swap points, we don't have bid or offer. We take the middle of the spread because we're going into a spot transaction, a forward transaction at the same time. The dealer will take the middle of the spread. So if you just quoted one set of points, they are swap points. Our next learning objective asks us to explain the arbitrage relationship between spot rates, forward rates, and interest rates. And the easiest way to do that is to actually look at the alternatives we have if we have $1,000 Canadian. So what is the first thing that we can do? Well, we can invest that $1,000 at whatever interest rate prevails in the Canadian marketplace. So we can invest at, let's put an interest rate sub D for the domestic market for some period of time T1. And let's draw that out so that we have a visual of what we're doing. T equals 0, T equals 1. We'll put $1,000 away for that period of time, and in T1 period of time we will have 1,000, 1 plus I D Canadian dollars. The other thing we can do is to convert our Canadian dollars to US dollars. So we'll convert to US dollars at whatever the spot rate is, FD. D, our base currency being Canadian in this case. So we're going to invest at the spot rate, and, we're going to convert to US dollars at the spot rate. And then, once we have our American dollars, we're going to invest at the foreign interest rate for the same period of time, T1. And let's see what that looks like. T0, T1. So here we're going to invest 1,000 SFD. That's our American dollars, right? We're taking our $1,000 Canadian, multiplying it by the spot rate. Since domestic is the base currency, whatever the spot rate equals, we multiply that by the 1,000 to get our American dollars. And in a year from now, in period T1 from now, we will have our American dollars, SFD, will have grown by whatever the interest rate is in the foreign market. So we'll have, at that time, 1,000 times the spot rate multiplied by 1 plus the interest rate. That gives us how much US dollars we have. All of this here is now an amount in US dollars. But we don't want US dollars, we need to convert this. So we will convert back to CAD, and we will do that at a forward rate. Now you might be saying, but we don't know what the forward rate is. No, we don't. We're developing an arbitrage opportunity, or an arbitrage argument to determine what it should be. So what we're going to do is we're just going to put the forward rate in and solve for it. So what do we need to do when we convert back to Canadian dollars, we need to take our American dollars and convert it back to Canadian. So we can multiply our American dollars by whatever the indirect spot rate is. Remember, this is a direct rate because the Canadian is our base. We can multiply it by SDF, or at that time, we can multiply it by the spot rate, FD. But we want a forward rate. We want to show that there's no arbitrage opportunity on day one, so we don't want the spot rate, we want the forward rate. But we want a direct forward rate, F over D. The same spot rate we used is the same forward rate we're going to use, so we can't multiply, we must divide, right? So let us take our 1,000 American dollars, 1 plus I to the F, and return those, F over D, at the forward rate. That will end up giving us Canadian dollars. So, for there to be no arbitrage opportunity, let's write that down, for there to be no arb opportunity, we must be indifferent between either direction, which means that the return we get here must equal the return we get here. That will help us solve the forward rate, right? So in other words, what we're saying is that 1,000, 1 plus I, D, must equal 1,000 converted into US dollars, growing at that rate, converted back to Canadian dollars, must be equal. Those two sides must be equal. If they're not equal, then there'll be a preference for one over the other. So if the forward rate is one in which these two sides are not equal, there is an opportunity to take one side or another, to go long on one side and go short the other side. And we're going to get to that very shortly here. So let's solve for this, and let's see if we can't figure out a formula for the forward rate. We can take the 1,000 out, and that will leave us 1 plus ID would equal the spot 1 plus IF over the forward rate. Solving for the forward rate, we can see just by algebra would equal our spot rate, the foreign interest rate, divided by 1 plus the domestic interest rate. So the forward rate is a function of the current spot rate, the interest rate in the foreign currency country, and the interest rate in the domestic currency country. We can observe the spot rate. That we just have to look in the market and see what the spot rate is. We'll know what interest rates are in the foreign and domestic currency countries. From that, we can solve the forward rate. So we see that the forward rate is nothing more than an interest earning argument. It's not an indication of what the market thinks the exchange rate will be 6 months from now or a year from now. There is no information in the forward rate that will tell us what the market thinks the rate will be. The forward rate is really just a function of the interest rate differential between the two countries and the spot rate. That's it. That's it. So, if, let's put our argument down, if we can earn more by investing in the domestic market, then we can, by converting to US dollars, having that grow at the foreign interest rate, and then using the forward rate to convert back. If we can do that, we certainly would. We certainly would do that. And how we would do that, for an arbitrage argument and an arbitrage opportunity means that we're not using our own money. It means that we can make a riskless profit by simply just putting a deal together. So what we're going to do is we're going to borrow US dollars. We're going to borrow US dollars because that loan will grow at this foreign interest rate. We're going to borrow US dollars, convert it into Canadian, invest in the Canadian marketplace. Then use the forward rate, which is misquoted obviously because these are not equal, to convert back to US to pay off the loan, and we'll end up with some profit. The next screen will show you an example of that. But what we would do in this case is we would buy CAD, sell USD. This would continue on until this forward rate made that opportunity disappear. It would disappear by the activity of doing this would change the spot rate such that the forward rate would now be consistent with what we have here. And that's an arbitrage argument. Well, let's actually see it in action now. So here is the formula we got to, the derivation, that the forward rate must be equal to whatever the spot rate is times the interest rate in the foreign country divided by the interest rate in the domestic country. That will give us the forward rate, and it must be that, because if it's not, then there's an arbitrage opportunity. Since that will be taken care of, since all arbitrage opportunities are taken care of, it must equal that. So let's look at an exchange rate. 1.6535, that's our spot rate that we can see, and let's not worry about what the foreign and domestic currency is, but that's the exchange rate. What this is telling us is, at this point in time, is that one of the domestic currency buys 1.6535 of the foreign currency, right? The domestic interest rate is 3.5, the foreign interest rate is 5%. From that, the forward rate must be the spot rate times the 1 plus the interest rate in the foreign market, 1.05 divided by 1.035 is 1.6775. That must be the forward rate. And this is for 1 year. We're assuming 1 year on this because we haven't adjusted the interest rates for any other periodicity other than 1 year. That's a 240 pip or 240 point premium, 2.4 cents if you figure it out. So the forward rate is the spot rate plus 240 pips or 240 points or 1.6775. Take your pick. Whichever way you say it, we get to the same conclusion. If the forward rate were 169 instead, here it must be 167.75 for there to be no opportunity. What if it were 1.69 instead? What would we do? What would we do? So let me give you a simple rule that you can solve any problem with, any single problem. In fact, with this simple rule, there is not one single asset class in the marketplace that will give you any trouble ever again. And it's a very simple rule. Buy low, sell high. Buy low, sell high. That's it. So what we need to do is figure out, well, which is the low side, which is the high side. The forward rate should be 1.6775. It's 1.69. So what we want to do is we want to buy 1 plus ID, and we want to sell SFD 1 plus IF over the forward rate because it's too high. So we sell high. How would that look? How would that look? Let's just follow the logic along and see if I'm right or if I'm just making this up, right? So we're going to borrow 1.6535 of whatever the foreign currency is. We're going to borrow 1.6535 of that. Why? When we borrow, that's the same as being short. We're short because we have to return. So that's the same as selling, right? We're borrowing money, so we're short. Because that's the current spot rate. If we have 1.6535 of the foreign currency, clearly we have 1 unit of the domestic currency. Because it takes 1 unit of the domestic currency to get 1.6535 of the foreign currency. It must take 1.6535 of the foreign to get 1 unit of the domestic. So we borrow 1.6535 of the foreign currency. We convert to 1 unit of the domestic currency, and we will short the forward contract. We will sell the forward contract at 1.69. So we're short this whole side. We have borrowed in the foreign currency, and we've converted it at this current spot rate to the domestic, 1 unit of the domestic currency, and we're going to enter into the forward contract at 1.69. We're going to enter into that forward contract because we want to be able to exchange it at 1.69. It's the wrong rate, so let's take advantage of it, right? Well, what's going to happen? What's going to happen? We have 1 unit of the domestic currency. What's going to happen to our domestic currency? Well, it's going to grow at 1 plus whatever the interest rate is. What's our domestic interest rate? Our domestic interest rate is 3.5. So at the end of the period, we will have 1.035 on the domestic currency. But we've borrowed over here. We need now to pay off this loan. Well, how much are we going to have to pay off? Well, we borrowed 1.6535, and that is going to grow at 1.05. However, we have locked in the exchange rate of 1.69. 1.69, which means once we've locked in this rate, we've entered this forward rate, which means we owe 1.0273 in our domestic currency. Setting up this whole thing, borrowing the money, having it grow at the interest rate because that's the value of the loan that we have to pay off, but we've entered into an exchange rate at 1.69, so we would need 1.0273 of our domestic currency to make this loan happen at that forward rate. However, the $1 we converted grew to 1.035. We only need 1.0273 to pay off that loan. There we go. So there is your arbitrage argument. So what's going to happen here is this is going to happen. They'll be borrowing in the foreign currency and converting to the domestic currency. This activity, borrowing in the foreign currency, selling the foreign currency, and buying the domestic currency, will change this spot rate to the point where these two sides will equal each other. And it will disappear. So the 1.69 may be the wrong price, but what will happen is arbitrage opportunities will step in until the spot rate changes. All of the selling of one currency and the buying of the other will change the spot rate until the spot rate changes such that 169 now is the right price and that opportunity disappears. But you can see how this was free. Look what I did. I didn't use any of my money. I arranged for a loan in the foreign currency. I converted it at the spot rate to 1 unit of the domestic currency, and I entered into the forward agreement at 1.69 on the short side to deliver, right? So my currency grew to 1.035. My loan grew to 1.0273. I make money. Okay, before we go, let's do one more little thing here and look at the relationship between the forward and the spot forward price and the spot price. If we can say anything about whether they'll be trading at a discount or a premium based on just observations of the interest rates, and we can. This is the derivation of the forward rate that we arrived at. Now, if we just do a little bit of algebra, if we bring the spot rate over and isolate these two ratios together, we can say something interesting about this. And this is just algebra that we did to get it to look like this. Look over here at this side. Our forward rate divided by our spot rate must be equal to this over here. Now, if we take the numerator, if the numerator is greater than the denominator, in this particular case, if the numerator is greater than the denominator and the left side and the right side must be equal, that implies over here, it implies that the numerator must be greater than the denominator. It implies that. If the numerator here is greater than the denominator here, it implies that the numerator here must be greater than the denominator, so that the forward rate must be greater than the spot rate if the foreign interest rate is higher than the domestic interest rate. Do you see that? If the interest rate in the foreign currency country is higher than the interest rate in the domestic currency country, we will have a situation where this side of the equation has a numerator that's greater than the denominator. Because it's an equality, the numerator here must be greater than the denominator here, hence the forward rate must be greater than the spot rate. Let's reverse that because we're looking at it in terms of F over D. So, but now F D over F over S D over F, we're taking the inverse currency on this case, 1 plus I D over 1 plus I F, and D and F can be anything. D and F can be anything, right? So in this situation, what we said was that IF is greater than ID. Well, over here, if IF is greater than ID, what we now have is we have the denominator is greater than the numerator. Do you see that? Now we put a situation where the denominator is greater than the numerator. Well, that must hold for this side too. So the forward rate must be less than the spot rate. So in this situation, if the foreign country currency is higher than the foreign country currency interest rate is higher than the domestic country currency interest rate, we will have a forward price greater than the spot price. If it's the other way around, we will have a forward price lower than the spot price. So here's a general rule that comes from these two statements. If the base currency is the higher yielding currency, forwards will be at a discount. If the base currency is the higher yielding currency, is that consistent? Well, D here is our base currency. And we said that the foreign currency was the higher yielding currency, not the base currency. If the base currency is the lower yielding currency, forwards will be at a premium. Forward is at a premium. The D is our base currency. We've allowed the foreign currency to be the higher interest one. D is the lower one, hence forwards at a premium. In this case, our base currency is F. Our base currency is the foreign currency in this particular one, because who cares what D and F are at this point? It could be any currency. But whatever is in the denominator is our base currency. F is our base currency. The base currency is the higher yielding currency, which it is. The base currency is the higher yielding currency. Forwards will be at a discount, is it? Forwards will be at a discount. So there's a nice relationship between spot rates, the interest rates in both the foreign and domestic country, the relationship between those interest rates, and what the forward rate will be.